Dorothy Simmons is 73 years old. She lives in Kelowna, British Columbia. She spent 31 years working as a municipal records clerk, organized, careful, the kind of person who kept every receipt in a labeled folder and never missed a bill payment in her life. When her son Marcus moved back to Canada from overseas in the spring of 2025, he started sending her $2,000 every month to help cover her heating bills and groceries. Dorothy was grateful. She never thought twice about it. It was her son. It was family. It was love. What nobody told Dorothy, not her bank, not her financial advisor, not Service Canada, is that those 12 regular e-transfers from Marcus, totaling $24,000 over the course of the year, had been quietly flagged by an automated CRA data matching system as a pattern of undisclosed income. Not because Dorothy had done anything dishonest, not because Marcus had done anything wrong, but because 12 consistent monthly deposits from the same sender, with no corresponding entry on Dorothy's T1 return, matched a profile the system is specifically trained to identify. 8 months after Marcus sent the first transfer, Dorothy received a formal CRA review letter requesting documentation for all income received in the 2025 tax year. She had no documentation, she had no paper trail, she had no written record confirming the transfers were family support and not payment for services. The review took 4 months. The stress cost Dorothy 2 trips to her doctor, and the professional help she needed to resolve it cost her $1,800 in accounting fees she had not budgeted for. Nobody warned Dorothy, not her bank, not her son, nobody, and Dorothy is not alone. Before I show you exactly what caught Dorothy off guard and what you can do right now to make sure it never happens to you, one thing: CRA enforcement rules change without warning, and they do not personally notify you before a review begins. Subscribe and hit the bell right now. Now let me show you what Dorothy did not know. Tell me in the comments right now, have you ever received regular e-transfers or cash from a family member without any written record of what it was for? Yes or no? Drop your province below, because what this community shares shapes exactly what we cover next. Here is what is happening across Canada right now in 2026. The CRA has significantly expanded its automated data matching systems over the last 2 years. These systems receive banking transaction data, investment platform reports, property records, and third-party income information automatically, without any action on your part and without any notification to you. The system runs in the background. It compares what is moving through your bank account against what you reported on your tax return. And when those 2 pictures do not match, the system flags the discrepancy for review. You do not get a warning. You do not get a phone call. The first thing most seniors know about it is when the letter arrives. For Canadian retirees, the risk is higher than for working Canadians for one specific reason. Your income is predictable. The CRA's systems know that a retired senior receiving CPP and OAS has an expected income range. When money moves through your account in ways that fall outside that expected range, large deposits, regular incoming transfers, proceeds from sales, the system notices immediately, and the burden of explaining that activity falls entirely on you. Let me walk you through the 5 banking activities that are most commonly triggering CRA reviews for Canadian seniors in 2026. Understanding each one is the difference between Dorothy's situation and yours. The first activity is cash deposits over $10,000. Any single cash deposit of $10,000 or more triggers an automatic large cash transaction report at your bank. This report goes directly to FinTrack, the Financial Transactions and Reports Analysis Center of Canada, the federal agency that monitors financial activity for signs of money laundering and tax evasion. Your bank does not ask permission to send this report. They are required by law to file it automatically. The deposit itself is not illegal, but if the CRA sees that deposit and cannot find a corresponding declared source on your tax return, a review begins. For a senior who sold furniture, jewelry, a vehicle, or personal belongings for cash, the absence of documentation connecting that cash to a legal source is enough to trigger a formal inquiry. The penalty for unresolved discrepancies of this type starts at $2,500 and can escalate to $12,000 or more, depending on the CRA's findings. The second activity is structured deposits. This is the one that catches people most completely by surprise because it feels like smart planning when it is actually a serious legal risk. If you have $12,000 in cash and you deposit $4,000 on Monday, $4,000 on Wednesday, and $4,000 on Friday, all to stay under the $10,000 reporting threshold. That pattern is called structuring. Under Canadian law, intentional structuring to avoid reporting requirements is itself an offense, separate from and in addition to whatever triggered the deposits in the first place. FinTrack and the CRA are specifically trained to identify exactly this pattern. What feels careful to you looks deliberate to them. The third activity is regular e-transfers from family members. This is Dorothy's situation, and it is the one that is affecting the largest number of Canadian seniors right now because e-transfers have become the normal way families support each other. Receiving consistent monthly e-transfers from your children or grandchildren, even when that money is pure family support with no strings attached, can be flagged by the CRA's automated system as a pattern of undisclosed income. The system does not know it is your son. It sees a consistent amount arriving from the same source every month with no corresponding declaration on your return. That pattern matches the profile of undeclared income. income. And without written documentation confirming the transfers are gifts or loans, you have no way to prove otherwise when the review letter arrives. The specific dollar threshold that most commonly triggers a flag is not the individual transfer amount. It is the cumulative annual total. 12 transfers of $2,000 equals $24,000 per year. For a senior whose declared income is $40,000, $24,000 of undocumented incoming transfers represents a 60% unexplained increase in apparent income. That ratio is well above the threshold that activates a closer review. The fourth activity is large account transfers and GIC consolidations. When a GIC matures and you move the proceeds into your checking account, or when you consolidate old savings accounts from multiple institutions, those inflows register as significant deposits in the CRA's data matching system. If the source of those funds is not clearly traceable to a previously declared account or investment, the system may flag the inflow as an unexplained source of income. For seniors managing multiple accounts accumulated over decades of saving, this is a more common situation than most people realize. The solution is not to avoid consolidating your accounts. The solution is to document the source of every transfer before you make it. The fifth activity is receiving money from outside Canada. If you have family members abroad, if you sold property in another country, or if you receive any funds from a foreign source, there are strict CRA reporting requirements that most seniors are completely unaware of. Receiving more than $100,000 from a foreign source in a calendar year requires a specific CRA disclosure. But even amounts below that threshold can trigger questions if they appear on your banking record without a corresponding declaration. For seniors with family overseas who regularly send financial support, the absence of proper documentation creates exactly the same risk as Dorothy's situation, a pattern the system cannot explain, leading to a review you were never expecting. Now here's the part most coverage completely misses, and this one involves FINTRAC directly, not the CRA. Most seniors know the CRA audits tax returns. What most seniors do not know is that FINTRAC and the CRA share data automatically and continuously. When FINTRAC flags a banking pattern, that flag flows directly into the CRA's review queue without any additional step. The two agencies are not separate silos that occasionally compare notes. They are connected systems that feed each other in real time. This means a banking pattern that your branch teller considers completely routine can simultaneously trigger a FINTRAC flag and a CRA data match review without anyone at either agency making a deliberate decision to investigate you. The process is automated. The outcome is real. Dorothy had no idea these two agencies were connected in this way. Most seniors never find out until the letter arrives. Did you know that FINTRAC and the CRA share banking data automatically, and that a pattern flagged at your bank can trigger a CRA review without anyone making a deliberate decision to investigate you? Drop your answer below right now. I want to know how many people watching this had no idea these two agencies were linked. Dorothy eventually resolved her CRA review. Her son Marcus helped her gather 18 months of bank statements, wrote a signed letter confirming that every e-transfer was family support with no expectation of repayment, and they submitted the full documentation package to the CRA through a tax professional. The review was closed with no penalty assessed, but the $1,800 in accounting fees, the 4 months of waiting, and the 2 doctor's visits for stress-related symptoms, none of that comes back. If Dorothy had known before Marcus sent the first transfer that a simple signed note confirming the purpose of the money was all she needed to protect herself, none of it would have happened. That is the entire point of this video. 3 steps you can complete this week. Step 1. If you are currently receiving regular e-transfers or cash from any family member, create a simple written record today. A signed note from the sender confirming the amount, the date, and that the money is a gift or loan with no expectation of payment for services. Keep 1 copy yourself and ask the sender to keep one. This single document is what removes the ambiguity that triggers a CRA review. It costs nothing and takes 10 minutes. Step 2. If you have made any large cash deposits, consolidated GICs or savings accounts, or received any proceeds from selling property or personal assets in the last 2 years, locate the documentation that connects those deposits to their legal source. If you sold a vehicle, keep the bill of sale. If a GIC matured, keep the maturity statement from your financial institution. If you received an inheritance, keep the estate documentation. If you cannot locate the documentation for a significant past deposit, speak with a Canadian tax professional about how to establish a record before a review request arrives. Step 3. If you have received any funds from outside Canada in the last 3 years, contact a Canadian tax professional or call the CRA at 1-800-959-8281 and ask specifically whether the foreign income reporting requirements apply to your situation. Do not assume the amounts were below the reporting threshold. Confirm it. Before we close, one warning that cannot be overstated. The CRA will never call you by phone demanding immediate payment. The CRA will never text you a link asking you to verify your banking information. The CRA will never threaten to have you arrested if you do not pay immediately. Every legitimate CRA communication arrives by mail with a case number and a specific response process. If you receive any phone call, text, or email claiming to be from the CRA and demanding immediate action, hang up immediately and call the CRA directly at 1-800-959-8281 to verify whether any actual review is in progress. Dorothy's story is not unusual. It happens to Canadian retirees in every province every single year. The only difference between Dorothy and a senior who avoids months of stress and thousands of dollars in accounting fees is knowing that regular family transfers need a written record before the first transfer arrives, not after the CRA letter does. You now know. Share this video with one Canadian senior in your life who receives regular support from family members. One share from you could save that person thousands of dollars and months of anxiety. What surprised you most in this video? Was it the e-transfer flagging pattern, the FinTrack and CRA connection, or the structuring rule that makes splitting deposits more dangerous than one large deposit? Drop your answer and your province in the comments right now. I read every single one. And if this video helped you, hit the like button right now. 1 second. It is the only way this reaches the next Canadian senior who is inside this situation without knowing it. I am Henry Jaden. Take care of yourself and take care of your money.